Hello traders, Gary Wagner here, just before 10:30 in Honolulu, 4:30 in New York, on Thursday, the 28th day of August, 2014, and this is the daily report for gold and silver. We do have precious metals higher across the board. Gold currently trading up approximately $6 to $7 higher. Current print on the screen, 1289.15. It has had a low of 1284.80 and a high of 1297.80. Silver also tracking higher, but as you can see by this dramatic high here, well off of the highs, currently trading up about 7 cents at 19.49. The low is 19.41. The high 19.99. More on silver towards the end of the show. Traders, earlier this morning, I sent out a special trade alert recommending long positions in both gold and silver, also recommending some suggested stop placement. Wanted to spend a couple of moments with you, talk about what led up to that. And really, the best way to look at the particular buy signal in gold, first of all, is going to be to pull up a daily chart. However, just prior to that, I want to talk about the stop in gold. Stop in gold is to put it below 74, and that was simply based upon these series of lows that we have had in here. They touch at around 74 as the intraday low, and then you can see it pops above, so we have good support at 80. The market really needs to hold 80. I believe 80 to be a pretty critical point. However, we have seen this market dip below that and recoup, and that's why the stop placement in terms of where I suggested it is at that particular point. Now, in terms of the actual trigger that led to us issuing the buy signal this morning, I draw your attention to this daily chart. First of all, on this daily chart, you'll see this is 73.10. This is basis the continuous contract of gold, therefore the stop, and I'll move that back to a pointer. Now, in terms of the buy signal itself, if you recall, as this market came down, we touched well below this 1280. Let's go ahead and try to get this line in as straight as possible. And so there was absolutely no doubt that this market was trading below 1280. 1280 was a pretty critical area. Market comes down. We have these very, very small days in terms of our body size come into the market. And then in yesterday's activity, we had a dramatic rise and we had a simple candlestick pattern that is simply known as an engulfing bullish. An engulfing bullish is defined as a market that has been in a defined downtrend. Well, we get that, meets that criteria. You get a red candle on a daily chart, and then on your daily chart, you open below and close above, and that's why the continuous contract of gold will work well for this. You're not going to see this in our spot market chart because it's a continuous contract, but you don't act upon it until you really get confirmation. We did get confirmation of that today as we got this large green candle. Now, although we are off of these highs are 97, the market has absolutely heated up in terms of the equities markets. The S&P is back below 2,000. Dow Jones, I believe, is below 17,000 right now. So that is beginning to move down. And we had an interesting formation also in the dollar index in which we had a couple of stars form above these recent highs. The dollar index, of course, has been extremely strong. All of those together are really the components that led us to issue our buy signal today. So traders, we're looking at a weekly chart, cash market of gold, and it's quite obvious we had an up week in the market. That's this small green candle. It also, in terms of the weekly candles, could, if we do close in this area, of course, give us a piercing line. But most importantly, what we are really noticing is a strong level of support over the last couple of weeks in the area that we talked about, which of course is 1274. With the heightened hotspots or geopolitical tension that is going on in the Ukraine, and the equities markets now appearing to possibly be under pressure, we could see that favor gold in terms of a bullish move. Now, realize that we do have a shortened week next week as we have Labor Day weekend coming up and the holidays coming up, but following that we will have a return of many of the traders that have taken a long summer sabbatical or vacation and are now going to be returning to their desks. So we should see a return of good liquidity, good open interest, good volume return into the market. So traders, we are looking at a 2-day chart. This is our Andrews pitchfork. Now I have created what is called a modified shift or a modified pitchfork that will attempt to plot some of the highs. And we originally plotted the lines by hitting 3 data points. This data point here, our high here, and our low here. We then used a modified pitchfork, and the modified pitchfork pulled this low up to here, and it then begins to give us some channels, and these channels are what we want to look at in terms of levels of support and resistance. We should have support along this particular lower line, this 0 prong, and currently we should have resistance, of course. Now we pegged it off this and this, but you can see it quite eloquently gives us our resistance here. So even on an upward market, we should begin to see a trade within this channel. We'll explore this chart with more detail next week. So traders, we've gone back to a daily chart, and on this chart, of course, we have been really looking at this basic trend in the market in which we have a consolidated trading range, really characterized by a series of lower highs as well as higher lows in the marketplace. Now, on this last move down, it didn't quite make it to this support level before apparently bouncing off, because we do have the market bouncing off that. In terms of resistance on this chart, our real resistance should come in at around 1311, but of course, right now, 1297, that's our intraday high as well as our 14-day simple moving average. That is where we are pegging our current resistance, 1297, then 1300. But I really think that that should not be an issue in terms of being able to break above that. This is the area that we have of concern, which is our real resistance level between 1311 and 1321. And now to silver. We actually issued a buy signal in silver, and the primary reason for doing that in terms of a technical basis is that, first of all, we've seen this market under dramatic pressure. And as this market fell, this 76% retracement level at 1935 seems to have held and really become a supportive area in silver. The caveat with silver right now is these extreme highs that we're getting, followed by no follow-through. In other words, there is no follow-through. We're not closing near the highs, and we've gotten these series of inverted hammers on the bottom of the market. That's my one concern in silver. But I do believe that what we are looking at is the fact that we're looking at a marketplace that has very, very light volume, low liquidity, low open interest, and because of that, we're seeing these wild swings in the market that we might not typically see during a trading time in which the majority of the traders were present within the market. My recommendation, of course, is to maintain our current long positions, maintain our stops. This has been Gary Wagner wishing you, as always, good trading, and we will talk to you for the wrap-up tomorrow on Friday, following our 3-day weekend in which no report will come out, of course, on Monday. Talk to you tomorrow. Bye-bye.